we are going to start our December meeting. So thank you all for attending. I note that Councillor Dunker's online today, and we've had apologies from Councillor Street. Are there any other apologies? John Footwood. We'll give John Footwood an apology. Thank you for that, David. Yeah, we will be thankful. Just on this occasion. I think any better. Well, I know that you're biased, Anton. Anton, you're biased. I'm sure he will protect you. I'm sure he will. Have we had any other apologies? No? No? Okay, excellent. Separation to income. Are there any others from the more? Well,
Okay. Right, I'm a recipient of a pension. All right.
Minutes from the previous meeting, to pages 11 to 16 of your document text. Those as a true record of that meeting. Okay, can I have a proposal, please? Thank you, Habib. A seconder? Thank you, David. Oh, right, okay. Oh, I'm happy to second it, don't worry. Okay, and can I just have a show of hands, please, that we're accepting that? Thank you very much. Okay, public question time. Now, we don't have any public questions I'm aware of. However, Mr. Reimers, further to the exchange of emails, I believe there is a comment that you wish to make. Is that correct?
Yes, yes, there is. Just a very brief statement. Thank you for permitting me to come up with that. So, shall I just read that out?
If you would, please.
Yes. Latest news, really, that came in just a couple of days ago, at least to me, and that is quite inspiring for all the members of the Brunel Pension Partnership. And that is that Wiltshire Pension Fund is to divest all fossil fuel assets by 2030. I'm not putting this as a question, I'm just putting this in as a bit of information, which may be well known to members of the committee already. Thank you.
Okay, thank you very much indeed. I was aware that that they have taken that as a process, and that is in common with some funds and not in common with other funds. I think were there to be a disinvestment of all fossil fuels, it would have to be done in a safe and controlled manner so as to not upset the financial balance that we hold dear to, because we are, at the end of the day, have to make sure we have sufficient money in our fund to ensure that we can pay all the members. Okay, I see Michael Dunk. Michael, good morning to you. You have your hand up. So.
Thank you, Simon. Yes, I just want just a quick follow-up comment on that, because I noticed as well that had happened. Well, they'd announced that, but also apparently they've also, and I don't know if anyone knows this, they set a target to achieve net zero carbon emissions across all investments. That's all investment portfolios by 2050. And I just wondered whether that's something that is inherent in Brunel, or whether it's particular to Wiltshire Pension Fund.
I'll pick that up. It is Brunel has its own policy, which I believe is 2050 as well. Each of the underlying funds has their own policy. Our policy is actually 2040. Whether and I have to say, I'm the first one that will say I have no idea whether we'll get to 2040, get there in 2040 or not. It's a statement of ambition, and you start the journey. And the journey will take the full 17 years, and may take longer or may take less. And as we get there, it may not be possible, because, as I've said on a number of occasions, for us to be net zero on our investment portfolio requires a broad swathe of investments to be net zero. We need a broad, diversified portfolio of available investments to be net zero, for us to be net zero. And if that change in the general market hasn't happened, there's no way we can be net zero. And,
Yes.
but the opposite is equally true. If
Yeah.
if a broad swathe of net zero investments become available well before 2040, then we can become net zero.
Yeah.
So it's an ambition, but it's not something that's actually within our gift per se.
The article that this also went on to list the problems associated with doing this, and I wondered if it'd be worth circulating it to the members of this committee just for their information, because I found it very useful to read. It highlighted problems like that one of the Brunel portfolios had gone up in carbon intensity, and they wanted to talk to Brunel about how that happened. So it doesn't paint a completely rosy picture about this. It does say there are problems, and I wondered if that would be, if I send it to, who would I send it to?
I've got the link. Well, I've got the link for the article that Sigurd provided.
Yes.
I've actually seen it in about 4 different places, and I was aware of it long before it ever got near the press.
But just for the information of the board, I think it's something that I didn't
Yeah.
realise.
I'm happy to circulate the.
Brilliant.
As I
Thank
said,
you very much.
The link. It is a complex business. And I suppose the other thing I should say is, whilst Brunel has a target for reductions year on year, the reality is that we shouldn't expect this to be smooth and linear.
Mm.
That would be grossly naive, I think.
Yes. Well, indeed. Well, that's another subject we could get onto at some stage, but
Yes,
presumably not now.
Yes,
Thank
we
you.
could take quite a lot of the meeting
Yeah,
if we
yeah.
wanted to. We'll move on.
Excellent, thank you very much. Okay, item 5 on our agenda this morning is the Independent Investment Advisors Report. So we need to have a verbal update. And
Good morning, Chairman. Good morning, everybody. Can you hear me all right?
Yes, we can.
Oh, good. Sorry, I thought I'd lost you for a minute. Well, obviously, you have my comments, which were sent earlier this week. Since then, things have sort of moved on a little, but I think probably not really very much, in that the markets have got more excited about rate cuts, and that probably inflation is at a level where they can happen, not immediately, but certainly next year. While on the other side of that, the central banks, and particularly the UK central bank, are busy saying, hang on, it's not as easy as you think to get inflation under control. We had a slightly more optimistic comment, or could be made to feel a slightly more optimistic comment from the Fed about what they thought about inflation. But there are still lots of nasties that could leap out, which are not really under the control of the central banks. I mean, if we had an extreme winter, for example, and energy prices came back under pressure, there are a lot of issues out there which could lead to nasty surprises. So I think, while I'm not a sort of longer term bear, I think the markets are getting a little bit ahead of themselves, and we do always tend to get a rally around this time of year. It's known as, they call it the Santa rally. So I think it's likely to calm down, get a bit more disappointing in the spring. Again, that's quite a common pattern. February is not normally a good month for markets. So that would be what I'd like to add to what I've written. As usual, I'm happy to expand on anything I've said or answer any questions that the committee would like to throw at me.
okay, ladies and gentlemen, any questions? Any comments? Paul?
Yeah, thanks, Chair. Could I just pick up and ask if you've got any feel for when next year rate cuts might be expected? Because obviously next year isn't that far away now.
I think the earliest I would expect to see anything, assuming no exciting, in a negative way, news is concerned, late spring would be my best guess at the moment. But I think it is quite difficult to see exactly what the timing is, because there are these unknowns that could hit inflation And in the UK particularly, if wage gains don't start to slow down, I think the bank will be very reluctant to take any action. So I think we'll probably see rate cuts in the US and in Europe before we do in the UK.
Okay, Councillor Farberhey.
Thank you, Mr. Chairman. That is quite interesting, Caroline, in terms of the potential rate drops in spring. But what about the strong sterling? What sort of effect would that have on?
If the UK keeps rates higher for longer than other economies, then that will tend to push sterling up. But again, that could be subject to political turmoil in the UK. I mean, I think investors are not taking a terribly positive view of the UK government at the moment. But if they feel they're getting paid for it in terms of rates, they may be inclined to put more money towards sterling. So I think betting on a depreciation of sterling at the moment is not something I would do.
Okay, Councillor Dunk, you've got your hand up. Is that a legacy hand, or did you want to?
It's a completely fresh hand, Chair.
Okay, yeah, well, there you go.
I wonder if we could ask Caroline, since COP has finally come out of the cupboard with fossil fuels and an attempt to across the world to say that we can't keep burning it forever, how long does she think that would take to filter through to the investment world, where obviously oil and gas companies will be looking over their shoulders a bit more? I wondered if she has any idea how that might impact.
Well, I mean, what we now have, I think, brought up to a realistic view is that oil and gas are going to be being used for quite a long time to come, even with decarbonisation. So, and I think there's been an overemphasis on the idea that somehow oil and gas companies in the short term are going to be a terrible investment because maybe they have some assets that aren't producing. If what they're producing is strong cash flow in the next 2 to 3 years, then investors will support them. I mean, you've got to look at your own investment results. Brunel have not been able to perform against the indices because oil and gas have been so strong because of the price rise. So I think it's, I don't think you'd want to go out as an oil company and start spending an enormous amount of money on some huge offshore field that you didn't think you'd be able to produce things from in 10 years' time. But if you're looking at, do I want to prove up something that I'm going to exploit in the next 5 years? Yes, you probably would.
Wow. Yes, there's a different subject there to be discussed about whether we should guide the market in the right place or whether we should react to. Anyway,
the problem you have there. Well, perhaps I just make a quick comment. The problem with divestment is that it doesn't really make much difference to the companies, because if you sell the shares, somebody else buys them. If it comes to, does an oil company want to raise new equity capital to invest in new fields, then the market, if it wishes to, can say, no thanks, we don't want you to do that. But clearly, I mean, it's very interesting that oil companies are going back to looking for new fields and, or developing existing fields. Now, they were going the other way. They've now reversed. Now, that's partly short-term due to pricing, but that also says to me that some investors are saying to them, get on and produce the oil. And the more of those who don't want that to happen sell the shares, the more the shares end up in the hands of the people saying, go oil.
Okay, well, you haven't cheered me up there, but thanks very much, Caroline.
Okay, any more questions for Caroline? I'm not seeing any. Caroline, thank you very much for your report, and we look forward to seeing you again soon. And if I don't get the opportunity again, do have a wonderful Christmas and New Year with your family. Take care.
Okay, could I, Chairman, I assumed you'd be wanting me to stay on a bit longer through Anton's
of course.
Through Anton's report.
Absolutely. I just didn't want to forget to thank you. Okay, I'm going to move on now to a review of our investment performance, and that's a report by Anton, and it's pages 17 to 50 in your paper. Anton.
And as usual, Chair, I'm happy to take questions on any part of the paper, but I'm going to concentrate in my brief remarks on the figures around the whole fund, starting on page 40. Markets at the moment are quite skittish, I think is the term. Yeah, you'll get a rally and then you'll get completely the opposite. And during the quarter in question to the end of September, the net of it all effectively was not a lot. So we didn't make really any noticeable return, but we didn't lose any money. But you'll see within that quite wide varieties. Actually, the UK market in September was quite strong, at sort of 2.5% return. Similarly, corporate bonds were quite strong, but UK government debt had another really poor quarter. And actually, just by way of sort of just sort of update that slightly, October was a pretty awful month, and November and December have been startlingly good to date. I mean, December was quite quiet until yesterday, until Wednesday night, when the Feds sort of made some more dovish comments, and then everyone decided that money was to be had, and the Santa rally was in. I've just pressed the wrong button. Sorry, I've lost my paging. What's it doing now? And so you will see on page 43, we continue to struggle to keep up with the actuarial target for this 3-year cycle. We're not sort of beyond redemption. We're only halfway through, although I can't believe we're already halfway through. But it does feel like we will, assuming markets remain sort of a little bit sort of skittish and not picking up a strong direction, it feels already like we're probably more likely to underperform that target than outperform it for the 3 years. And that's not a disaster, yeah, but it does mean that the next actuarial valuation is likely to be at the margin slightly worse, all other things being equal, which they never are. And then there's a couple of things to pick up just on pool, or one thing in particular to pick up on pooling. We have a strategic target to invest 5% in private equity. The way that works with Brunel is different to the other investments we invest in. We make a commitment to every 2 years to an amount to a cycle, which then takes up to 10 years to invest and return that money. And so it's deeply illiquid. And therefore, as each new commitment comes up, I ask committee to reaffirm that they would wish to continue with that rather than just assume, because once it's in, I can't really get it back out again. As I say, our current strategic target is 5%. I've made a recommendation consistent with that of what I think the commitment needs to be for the fund to be at 5% in the long term. It is definitely a case of using a bow and arrow to hit a moving target in the wind to get that to 5%. But yeah, the only thing I will also mention, so you will be aware that the government now is suggesting that we should have a target of 10%. If the committee wishes to, we can up what we put into this one, although our current stated and agreed target is 5%. You will opine again on that overall target next year. That is a piece of work that we will be working through next year as we look at all of our investments and what our strategic asset investment should be. I'm quite comfortable with the idea that as and when we change that formally, we then sort of work through that and just aim at that target in future. But if the committee has a particular view and wishes to front run, then I quite happily will give you a different number, which funny enough will be double the number I've suggested. So happy to take questions on that, but then I will need you to formally approve that. Or not.
Okay, thank you. Just a quick question for me. We 3.7 million was added to the Brunel Private Equity Fund, according to this, and I noticed that the value of the fund has diminished from a peak in
The overall fund.
the overall fund. Yeah, had its peak in late 21, maybe just early 22. Now we're coming back up to those sort of levels. Do you think it will have returned to its original, just a shade over 3 billion, or just a shade under 3 billion? My apologies. In the next 12 months?
I knew the answer to that. I'd be out investing for someone else. It is, as per my earlier comments about market directions or lack of direction. If I was a rampant gambler, I would probably say no, but without much conviction. I think we will be somewhere between 2.7 billion and 3 billion in 12 months' time, would be my considered sort of view, but where in that range it's quite difficult to say. As the private equity is targeting, so what happens with the private equities, we make a commitment to this Brunel cycle, as they call it, cycle 4. We've already made commitments to cycle 2 and cycle 3 that are in train. And as I say, each one of these typically lasts 10 years. So in calculating what I recommend, what I'm saying is, right, I think the average fund will be at this level, which is a bit of a punt. I've then got 5 cycles in train, so I'm going to take a fifth of that. Because of the nature of the cycle, each cycle slowly builds up and then comes down. On average, only half of your commitment is actually invested at any one time, as a rule of thumb. And you do the maths and you come up with a number. Is it the right? It's it's not a precise science, this at all. But I think that the 70 million I'm recommending for the commitment, which would be drawn down, as I say, typically there's usually 4 to 5 years for it to draw down, 2 to 3 years in the middle where it's fully drawn, and then you start getting your money back noticeably. I think it's consistent with that, but it's not precise. And to give an example also, how these things can play out, there is the somewhat awkward and extreme example of the Southwest Regional Venture Fund, which we don't talk about very often because it's only £1.6 million and therefore not worth really the conversation time. But that's a private equity fund that had it initially a 10-year life, but it started in 2002. So do the maths and you can work out that it's been extended massively. Although now it is officially, legally, it is in wind up. Our first one with Neuberger Berman was 2009. I think they are expecting that to wind up this year. So typically they do tend to run a bit longer than 10 years. But that Neuberger Berman one, I think we've probably had more or less the value of our commitment back. I think it's now just profit that's sat still to be returned, as it were. So it's not an exact science, even the timing. When I say 10 years, you hope it's going to be 10 years, but experience tends to show that there's a bit of extension on the back end usually.
Okay, David.
Can I just ask you about the funding level graph, which is on page 46? So the scale of it, I think is a bit misleading, but there is clearly a shock fall in value of the fund round about January, February of 23, I would imagine, which is quite a significant fall. And then it's leveled off from there. So what happened during that period of time to lead to that fall? And is that something that can be recovered? Is it a temporary blip or is it a permanent blip?
So with funding levels, all things can be recovered. It's just, it's usually a question of over what period rather than whether it's possible. Yes. What that is that the actuary effectively included the uplift to pensions for every year. Pensions in payment get uplifted by inflation from the 1st of April using the previous year's September CPI print. And that is the impact, largely speaking. There are some other minor impacts or other influencing criteria things. Sorry, my words aren't coming out this morning. But largely that is the impact of them going, right, we weren't including that. And now today we're ticking the box of including that. Because I think last year it was 10+%. And obviously that's not 10% and then it goes away sometimes. So that's 10% is in the figure and then next year's inflation gets added on top of that. So at that level, it's particularly large. Now, you won't get that bigger step this year for two reasons. One is the inflation print just isn't as large. I'd have to look it up. I think it was about 6.5%, 7%. That sounds right, at September. The other reason is that the actuary, we haven't had 10% inflation for a while. Now they've had it once and seen what it's done to the figures. What they've done is gone, okay, we need to think about that. And rather than tick it in as a lump as soon as, sort of include some element for it through the year as it becomes clearer as to what it will be. So it will be added through the year rather than as a great big punch in the face in one go. So it won't be as big a hit, or I don't expect it to be a particularly noticeable hit this year, but that's what it was, yeah, and that's what it is. And because of the CPI nature, linked nature of the fund, both in terms of pension in payment, but also deferred pensions. So if you're an officer that has left service but pre-pension years, your benefits get uprated by the same CPI figure each year. Inflation is inherently expensive for the fund. Although it's one of the things that we can mitigate in the long term through our through the investments we hold. In the short term, it's nasty, and we particularly don't like it. In the long term, we don't like it, but we can take steps to mitigate.
Okay, Katie Farber.
Thank you. And Anton, in your view, the sort of 10% target that the government is encouraging, what are the private equity? Is that really, excuse me, to stimulate the market or is it because the return on investment is higher, or is what are the risks? Excuse me, what are the risks associated with it?
So if we compare private equity versus listed equity, We'll take the risk of investing in companies as read, as it were, and we'll just talk about the differences between the two. So the explicit and legal difference is that a listed company is on a listed market where market makers, investment banks, are required to provide liquidity on a constant basis. So irrespective of the price you can get, you should be able to sell your shares within a relatively short period of time, whenever you please. With private equity, that is not the case. To sell the shares of that company, you have to go out and solicit bids from somewhere. There's no sort of set mechanism or set price. And so it is inherently less liquid, and financial theory states that if you are taking a risk, you should be rewarded for it. So you are taking an explicit risk around less liquidity, and therefore you should be rewarded for it. Now, in some instances, also, the companies involved are broadly the same. So, for instance, I can't remember where it is. I think Boots currently, as a company, is owned by private equity. It has been listed in the UK. There's talk of the private equity company relisting it. It's a big company that's as big as any other retailer in the UK, and there's no real difference other than the fact that it's not listed versus listing. But as a tendency, private equity companies are smaller. And there is obviously a group within venture capital which are startups. And obviously with startups and very small companies, again, there are inherent more risks. And if you're invested in a venture fund, that venture fund might invest in 40 companies, and actually you would probably expect 15 to 20 of them to go bust. That is the nature of that style of investing. And you make massive returns on 2 or 3 companies, the next Amazon, maybe, if you're really lucky, but a good portion of them will be a bit, and some of them will go bust. And so that part of private equity is inherently more risky. Now, over time, private equity probably does provide, the statistics suggest they do provide a better return. You can also argue that they use more leverage, more debt. Again, that's not inherently necessarily a characteristic of private equity versus listed. It doesn't have to be that way, but it tends to be. So it is more risky in a number of ways. Historically, you have got better returns from it. Is there something inherently wrong with 10% against 5%? No, it's a judgment call. Is there something inherently wrong with the government insisting that and making that decision for us? Well, probably, but that's a different discussion. So there's nothing inherently wrong with a 10% target as opposed to a 5%, and there will be other LGPS funds that are nearer that. We also don't, as a fund, we haven't chosen in the past to invest in infrastructure. If you invest in infrastructure, then actually the structure of the physical investment structure of that tends to be private equity led. So it's not quite as simple as saying the label has to be this and this is the label. So we'll work through that debate next year, because also part of the discussion is if we want to increase our private equity exposure, then by definition, we need to reduce something else. So it needs to be a holistic discussion about the whole fund and the risks, because what you might do is you could take a lot of money out of listed equity, put more into bonds and more into private equity, and not increase the overall risk of the fund. So there's lots of different ways, and we need to have that debate in an organised space and in an organised way. But 10% isn't inherently wrong. And I think Michael has a question.
Right. Okay, we've got a couple of open microphones, so if you can turn your microphones to mute until you're asked to speak, and I'm going to take them in the order they
Well, I was
came.
going to say, I suspect Caroline probably wants to,
Yes.
with due deference to Michael, who I'm sure has a very interesting question, I suspect Caroline wishes to add comments to answers I've already given.
Took the words right out of my mouth, Anton. Carol?
The only comment that I would want to add to what I think Anton's really covered nearly all of it is to say that the other thing you need to bear in mind when we come to this debate is that the returns on private equity have been very good if you've been with the right managers. Some of the private equity funds have not done well at all. So I think there's some naivete in the way the government has looked at those returns. And I also think that if they think this is going to get a lot of money into the UK, unless they choose to specifically direct it, I think they're going to be disappointed.
Okay, thank you for that, Caroline. Michael?
Thank you, Chair. It's just that I found that very interesting, actually, and I really wanted to ask about partially how we choose, if we haven't the ability to choose these investments, and also to try and understand the whole subject a bit more. I mean, I on a very, very, very small scale have invested in some, I think they could be called private equity projects, basically where I could lose everything or I get a very good return from either 6 to 9 or even 10%. And sometimes they've had to reschedule the whole payment system, and companies have not achieved the expected outcomes. And in an extreme case, some of the solar in Africa, for instance, just didn't stack up, partially because of COVID, I think. But in terms of, I mean, that portfolio that I've got, which is minuscule, is all really mostly renewable technologies, or technologies that could be described as going in that direction. And I wondered if we had, under this umbrella, any ability to choose, and whether that would be a suitable place to have renewable investments, whether they're UK or not, because that does encourage that sector and help to fund that sector, which unfortunately the government probably haven't been doing, been relying on the private sector.
So in simplistic terms, we don't get a lot of choice, because, and this is, this is where you end up slowly, is that the government has said thou shalt pool, and they have strengthened that. And therefore, although we as a client owner get to discuss with Brunel what they offer, effectively we have to tie in with what Brunel offer. Now, most of what you're talking about in terms of renewable solar parks, wind farms, etc., tends to fall under the banner of infrastructure, not private equity. There might be private equity companies that do it, but it's more likely to turn up in infrastructure. And so infrastructure is something that Brunel offer. We've chosen not in the past to invest in it. The only thing I will say is that I am aware that that portfolio, because I discuss all portfolios with Brunel, or I'm in the room when they're all discussed, has struggled to invest because there is too much institutional money chasing too few renewable energy projects currently, because quite a lot of pension funds or institutional investors have come out and said, I wish to invest 15% of my fund in renewable energy, and they're chasing a number of investments that just aren't there at the moment. And that simple supply and demand, you've got a lot of capital chasing very few investments, good investments, and therefore the returns are muted. And so that's why Brunel and the managers Brunel hire have struggled to get the money to work in that portfolio, because it's just not out there. It's just not working. And that, as I say, that's because there's too much money chasing too few opportunities. Now, we can then go into the debate about whether if government suitably encouraged the market, then more opportunities would be around, and etc. And infrastructure, we will have this debate next year. Infrastructure will be sort of back on the table, as it were, for a discussion. Ultimately, it'd be the committee's decision as to whether we invest in it or not. We'll go into it in depth at that point. But it's more in that frame than in the private equity portfolio. The other thing I would say is that investment markets have a sort of inbuilt way of adapting. And this applies both to getting rid of obsolete companies and technologies and bringing in new ones. Yeah, if you looked at the FTSE 100 or the S&P 500 in the States 30 years ago, you'd have seen no tech companies. Oil companies and banks would have been massive, and retailers would have been massive. Domestic, high street retailers. Now, I don't think there's a high street retail company in the FTSE 100. There's still some supermarkets, but no retailers. Fossil fuels is still large but diminishing. Tech is massive. Markets will slowly, companies come and go, and businesses come and go, and markets do have a way of slowly culling things and slowly bringing them on. So we are always investing in infrastructure or in renewables, because we might own Siemens, that is the biggest creator of wind turbines. They also produce trains and God knows what else, because they're a massive industrial conglomerate.
Yeah.
But we're always investing in these things.
Yeah.
Because if they're attached to good companies making good decisions and making good profits, we invest in them, because that's what professional fund managers do.
Yeah.
And as companies invest or are tied to industries that don't have a future, slowly but surely markets do cull them. Possibly not at the rate you would like to see for a given industry, but it will happen, and it will be organised, and it will be slow and gentle.
Yes, it's a bit like, I mean, I got some stuff in Tidal and.
You've muted yourself.
You've muted yourself by mistake, Michael. We can't hear you.
Muted yourself.
Sorry, I'm just going quickly. So I've got some stuff in money in wind power and tidal power, and not wind power, wave power and tidal power, and they're minuscule. I think the sector is minuscule because no one's putting any money into it. But who knows in the future? Anyway, thanks very much.
Okay, thank you. Paul, you had a question.
Comments really, Chair. Just to pick up on a point that Anton had made, 10%. In some ways, it's neither here nor there, increasing from 5% to 10%. But as a matter of principle, I am uncomfortable with that being given as a direction. As a pension fund, we have priorities and obligations. I think it's a really blunt tool of government. As Caroline has said, the result is unlikely to be the direction that the government wants, but I think it distorts our ability to manage the portfolio, and I don't think that's helpful. But most importantly, I just wanted to put down a marker that I'm strongly averse to taking moral and ethical and good cause positions on the fund, partly because of our obligations to get a return for the fund, and we know the challenges there. We know the actuarial challenges that all pension funds are facing. We know the investment return position regardless is challenging. Anton's talked about inflation, and we can look at and as a body with individuals in this committee can look at areas of investment that may be highly desirable, such as renewables, health, housing, public transport, all areas that are desperately in need of investment that have a huge moral weight behind them, but would significantly distort our underlying position. And I'm really concerned if we start talking in those terms.
I think my own view is broadly speaking exactly the same as that, Paul. I think our first and foremost obligation is to ensure that the fund is capable of paying the members the pensions they have saved for all their working lives. And that has to be our guiding light first and foremost, in my view. And I agree with the other comments from Anton and yourself, Paul, about where we are with that. I think being instructed to spend X amount or invest X amount of our funds in a particular area is not helpful, and actually makes it harder for our fund managers to guarantee that we are able to pay all our members the pensions they have saved for and have paid for. So I would agree with your comments. Councillor Harbour, you wanted to come back?
Yeah, mine is another comment in line with that, potentially with what Paul had to say. It is interesting to note that the head of COP28 is the head of ADNOC, Mr. Al-Job, that is actually accelerating all explorations. So just identify what the direction of travel is short term. And I think once they're actually going with renewable, they're actually accelerating oil production at the same time.
Okay, thank you for that. Now,
Caroline has a...
oh, sorry, Caroline, you want to comment?
Sorry, Chairman, no, I can't seem to get my hand down. I apologise.
Okay, not to worry. Thank you. Okay, well, I'm going to move on now because I think we had a fairly good discussion on that. And there is a recommendation, or rather there's an issue for consideration, which is that we at 2.2 on your papers on page 17, and that is that the committee is asked to approve a commitment of £70 million to the Brunel private equity cycle beginning the 1st of April 2024. Now, I am happy to propose that from the chair. Do I have a seconder for that? Thank you, David. And can I see those in favour, please? That's all. That's the voting members. So that's unanimous from the voting members. Any abstentions or voting against? No. Okay, so that's all we need on that, isn't it, Anton? Yep. Okay.
Yes, thank you.
Yep, no problem. So we're going to move on to agenda item 7, which is page 51 of your pack, or starts on page 51 of your pack. Rachel.
Sure.
Good.
Surely.
It's
Going to be Shirley. No
Shirley,
worries.
my apologies.
That's quite all right. Rachel did write the paper. I'm just delivering it to you guys today. That's okay. So as you are aware, Peninsula Pensions monitors performance in line with the disclosure regulations, and the information within this report is based on those statutory targets. So I'm pleased to say that during the quarter ending the end of September 2023, total performance in target was 92%, with 94% against the higher priorities. This is shown within Appendix 1 of the report, providing the full breakdown of the admin performance across the 3 priority levels. And we have also included additional details in relation to the complaints that are mentioned within that quarter as requested by the Somerset board. It also provides a line graph showing the monthly trend of percentages in target for the high, medium and low priority categories over a longer period of time. Appendix 2 has some more figures for you there. So this shows the longer term performance, with the second graph showing the number of outstanding cases, including those that we're awaiting responses from the employer, the scheme member, or another provider where the scheme member is either looking at possibly transferring in or out of that provider. Appendix 3 compares amount of work received over the previous 12 months compared to the previous year. This time the chart is showing a slight decrease in work, which is different to the recent trend. So I just wanted to point that out to yourselves. And then I would move on to McLeod. McLeod Remedy is moving forward now that the regulations are in place from the 1st of October. But because they only were approved in September, nationally, the database providers have had some issues, and we haven't been able to get everything as we want it to be within our database. So that amendments are being done, and we should have them in operation from January. So it has meant some of the work has to have been done on a manual basis by the team. We do have Pacific team members involved in the McLeod project, so that this then allows others of the team to continue with the business as usual cases to keep the work flowing smoothly. The main part that I've actually been involved in personally, along with Rachel, is that we have been reviewing the pension administration strategy, and we are consulting with employers at the moment, and this is ending December 2023, 31st of December. We spoke with employers at the November meetings about the changes that we were looking at making. And the strategy considers not only the disclosure regulations, but also the internal targets for Peninsula and the expected performance of individual employers. And we have shared a link with yourselves to the draft document, and also pointed out the key changes we're looking at making. One of the ones which may be the most sort of contentious is we've strengthened our section with regard to charging for underperformance and lack of engagement. We did have in the current policy, we do have mentioned that it is possible for the fund to actually charge fees for the additional work undertaken, but we didn't have it set out in, so, as we have done now, making it a lot more clearer what could be charged to different employers. When we looked at this, we did take consideration of other funds and how they look at the charging schedules as well, especially those around the southwest. And in discussions with administrative colleagues, we also found that although the charging is there, they have charged a couple of different employers, but most of them don't need to have a charge put against anything that they've done. But what has also happened is that the provider of a service will also say if there's a fund that is charging and a fund that isn't charging, they would do the fund for the work that has that charge in place first. So we're actually getting a letter of a service or a letter of engagement with that employer than another fund, because we haven't had those charges relayed. Obviously, our main aim is to have engagement and support employers to carry out their responsibilities, and we need them to do their part so that we can also do our parts and meet the disclosure regulations, so that we can get the information out to the scheme members, which is, you know, our main priority in all of this. As I say, it's a contentious issue, so I just thought I'd share with you some figures, if that's okay today. And that is currently for the Somerset Fund, we have 141 employers that we have outstanding cases with that we've had to chase. So that means that they've been outstanding longer than like a couple of weeks, longer than a month in most cases. Of that 141, 43 have over 10 cases. This moves down to just 12 with over 20 cases. But of that 12, we reduce it down further so that you have 4 cases over 30, 4 employers with over 30 cases outstanding, 2 with over 60, and one of those has nearly 150 cases outstanding. So in total, we have over 1,200 members that we can't do because we haven't been given the information that we need, be it sort of like a leavers information, or it may be a query on service or pensionable pay that we haven't been able to get to the bottom with an employer to actually move things forward. A lot of those cases are also with it looks to be with our academy colleagues, and we do know with academies that the admin staff do move over, so it's really those that we're trying to engage with. And if the engagement goes through, then we're not saying we're going to charge them, because they've, you know, we're working with them to get to a good place for both of us and for the scheme members. And what we would say is we'll just have like something in writing to say that things will be improved by a certain date, and then as long as it didn't fall back from there, then there wouldn't be any fees. So I hope you understand where we're coming from with that. Obviously, following the consultation, we will be bringing the strategy to the committee and the board to actually approve before it goes live. So you'll be able to see what we've had from the feedback and any adjustments we've made at that point as well. And then I just wanted to just mention, moving on from the strategy, is that we've been able to provide the annual benefit statements within the statutory deadline of the 31st of August. This was a push for the Somerset Fund because there were, we asked for information sort of by the end of April, and we didn't get some of the fund employer information, some of the larger funds, until very late this year. But you know, we were able to do that, the team worked to get things sorted. Okay, any questions from anybody?
Okay, thank you for that. Just as, for clarification, the review of the strategy, the consultation we're undergoing till the end of this month.
Yes.
That report will come back at our March committee meeting, is that right?
Yes, and it's going,
yeah.
Anton can confirm, but it should be going to the Somerset board on the 12th of January. Is that?
Certainly the plan.
Yeah.
Okay, so we've got a timeline. That's what was interesting, making sure we understood the timeline. David, do you have a question?
I have it. It's a specific question. It relates to Appendix 1, the performance summary, high priority cases, which I noticed you mentioned was 94%, but in actual fact it's 79%, where the issue is one of death, people in quite vulnerable situations. So there's 43 death-related cases which have not been dealt with on time according to the service level. I just wonder if you can give us an insight into those 43 cases.
I haven't looked at those myself personally. So what I do know with the deaths is that we do that they can take a while to sort out, and it may, I think what's best is if I look at that and come back to yourselves on that separately. I mean, I can sort of like guess, but I would rather give you the true response on that.
If once you've got something, surely send it to me and I'll make sure it goes round.
Yeah, perfect.
Yeah, my concern is the time you really want your pension to be working properly is when you've got a death, and if it's not working at service level, we need to understand why.
I agree
Yeah.
entirely. What we don't want to do is wait till the next committee meeting before we know. So that's why I want to
No.
say that. Okay,
Yeah, no,
excellent.
that's fine. I think like sometimes with the deaths, we're waiting on different things that like deaths themselves, if they've got to wait for probate, etc., can take time. But that would be that we haven't then maybe chased that or updated our task correctly. But that may not be the only reason. So hence why I'd rather go to Anton with that.
Excellent. Any other questions? I'm not seeing anybody online. Not seeing anybody in the room. Anybody got any further questions or comments? No? Okay, we'll go back to page 17. Well, there was no other recommendations. Was there? Okay. For that one. Just double check. No, it was to note the report. I thought that was the case. I just want to make sure I hadn't missed something. Okay, we're going to have a 5-minute comfort break. So if we can pause recording for 5 minutes, please, and we'll be back dealing with item 8 on our agenda, which starts on page 61 when we return. Okay.
So I was just going to turn my
Right, ladies and gentlemen, we're going to restart the meeting. We are at agenda item 8, which is page 61, starts on page 61 of your paper pack. And this is our business plan update. And turn to Anton.
So as usual, two parts to the business plan update. One is the sort of formal, well, here's some stuff to add to your agenda going forward, and the main difference there in terms of the work plan is to formally put in the admin strategy for the March meeting. I should also slightly temper that whenever there's a consultation going on a strategy and we've timetabled it, there is the possibility that the feedback from the consultation will be so dramatic as to push back the point at which the committee considers it. Now, I sent some minor feedback to Shirley on it, mostly on a couple of typos I'd spotted. And she did point out the level of feedback she'd received at that point about 10 days ago, and it wasn't massive. So I think that's a fairly low risk, but it's always a plan. You'll notice on the sort of more business plan rather than the formal work plan, I've added this stuff around reviewing the investment strategy statement next year, etc., etc. So that's the sort of the business planning part. Also within this paper, I usually use this as the excuse to update you on various things that are happening, sort of government regs, etc., etc. So unless there's any questions around the sort of formal business planning bit, I will move on to the general update on life and the universe.
Okay, questions on the business plan?
Life in the universe it is then.
Yeah, I'm not seeing any. I'm not seeing any hands. Well, we'll move on then, please, Anton.
As usual, there are a number of things going on at the moment. In terms of sort of my working life, there's ongoing discussions with Brunel about lots of things, always. So that's sort of, but nothing that I feel instantly compelled to update you on. There was the, sorry, I'll deal with the simple stuff first. One of the other things I didn't mention in the paper, but I will just mention quickly to you now, is we are actually currently in the process of tendering the actuary contract. We're doing that jointly with Devon because it would be inherently inefficient and awkward for Peninsula Pensions to be running two pension funds and them to have different actuaries, because actuaries have slightly different ways of working and different web portals, and yeah, just nightmare. So we've done that as a joint tender, explicitly a joint tender, and we've stated we will appoint the same company, but we will then sign separate contracts. So it will not be one contract, it will be two contracts, but we will appoint the one company. Colleagues and I, myself on behalf of Somerset and colleagues at Devon, have been scoring the tenders received in the last week or so. We've got a moderation meeting first week of March. Our current contract comes to an end with Barnett Waddingham on the 31st of March. We will definitely have made decisions and everything prior to that. And then, if necessary, there may or may not be the need for a transition plan that might mean that the new actuary, it's common when you change actuaries in the LGPS for work started before the changeover date to stay with the prior actuary for however long it takes to resolve. So in a scenario where we did change, Barnett Waddingham may still end up tidying up an odd piece of work for 5 or 6 months. And so you just tie up things around that. I can't possibly comment as to whether Barnett Waddingham have tendered or not. Certainly not in an open forum. But that is under the written scheme of delegation. That is an officer decision as to who the new office actuary would be. that is in train, in process, organised, on time. Subject to the timescale being acceptable and everything, and us having completed the procurement process to a suitable point where it can be announced, then yes, I would tell you in open session. If I don't in open session, you can grab me afterwards, and I might tell you in private. Because I'd be very disappointed if I don't know by that point what the resolution of that tender is. I very much suspect I will be able to tell you in open session.
I would sincerely hope that you can. David.
So actuaries, I think, all have different approach to technical provisions. Is there a danger here that by changing actuary, we can see a similar jolt in the figures by a shift in technical provisions?
I suppose ultimately the answer is yes. So if we change actuary, there is a greater risk of more change at the next valuation than if we have the same actuary using the same, specifically the same calculation. For good or bad. So in assessing the tenders, we're assessing the good and bad points of their methodologies, but inherently saying that the incumbent is better because it is the incumbent is ultra-virus. That would be not be a suitable comment.
Be aware of it if we do change actuary, that could be an impact.
Although the point at which it becomes sort of actually hits money, hits cash flow for employers, would be the 1st of April 2026, when the next valuation results come through. Because the thing with the figures I showed you earlier is they're not true. They're an informed opinion of the actuary. They are not inherently correct or wrong, and the actuary changes them as they get more information. So, as you say, you could have a change in methodology that gives a change of answer, but that doesn't necessarily mean that answer is more correct or less correct than the previous one. It doesn't mean the previous guy was wrong. It just means it's been done by a different person on a different methodology, and they've come up with a different answer. But it is a risk.
Okay.
If there's no other questions on that, I was just going to touch on the joy that is the government's response to the consultation that we discussed at the last meeting.
Indeed.
So those of you that were there will remember we had a at length discussion about a consultation that the government raised following the Mansion House speech. I think it was on the 10th of July. I remember it well because I was going on holiday the following day. Yes. Well, no, going on holiday was the joy. Coming back and having to deal with the Mansion House speech. In a move that is not uncommon for government, despite significant feedback that some of their proposals were not welcomed, they, broadly speaking, said, no, we're going to implement them anyway. So to use one example, I believe in their own response to the consultation, they quote that I think it was 86% of respondents felt that the mandation of a 10% requirement for private equity was a bad idea. And they said, but we're going to do it anyway, although they have slightly softened their approach, because rather than mandating, most of it will be on a comply or explain basis. And obviously the devil will be in the detail of the guidance or regulations they subsequently publish, but it looks like most of it will be on a comply or explain basis rather than a legal requirement. But as and when we get more detail on that, then we can respond to that. And in the instance of the areas where they are making suggestion around investment strategy, it's actually probably quite helpful for us as a fund that we are on a purposeful schedule opening that particular can of worms anyway next year. So I'm hoping that their feedback is sufficiently timely that we can include it. Although I suspect that if they haven't really got there by the spring, then I'm not sure they perhaps will, given the timelines for an election next year. I suppose one comment I have had a number of times, which I will pass on, not to do with the mandations around private equity and levelling up projects and things, but around sort of size of pools and consolidation of pools. The general wisdom around banding around figures like 50 billion by 2030 and pools of 200 billion by 2040, which by their own estimations means 4 or 5 pools rather than the current 8, is that the word on the street on that is that that is not a party political thing. Labour believe in consolidation of that as well as the Conservative Party. And actually, the true driver of it is the Treasury. And one presumes, therefore, a civil servant or group of civil servants in the Treasury. So for better or worse, that is almost certainly, that particular element of the consultation is likely to perpetuate almost irrespective of elections and results of elections next year. Other elements around the private equity levelling up may be more malleable. I suppose one of the other things that I find interesting with the preference of the government for us to invest in 10% in private equity is the complete lack of understanding of how that works. Because as I said to you earlier, it's a 10-year cycle and you build up cycles. And so, for instance, we've got a 5% target. We started with that target in 2009, and we're not that far off it now. We're about 4%, I think. And I suspect we will probably get to 5% in the next 2 or 3 years. If they say 10%, I suspect it would take us 7 to 8 to 10 years to get to 10%, depending, assuming we agree to it. So it's not, oh, we as government have said we want you to target 10%. We agree that we're going to target 10%, and 2 weeks later we're at 10%. That's not going to happen.
Okay.
Happy to take any questions around the consultation and the various bits of it.
Okay. The one point I will make is I think I'm right in saying that effectively Brunel will be at that first figure, 50 billion, by somewhere around 2030. I mean, obviously it depends on performance. Of course.
So if you start making, if you look at our historic 10-year performance, I'd have to look back at my first report. I think it's something like 6.5%, 7% per annum. And okay, you could get a slightly strange 10-year period. So if you did that in 2010, you would include both the dot-com bubble and the GFC, and you'd probably end up with 4% or something rather than 7%. But I think I worked out that Brunel would need investment assets, assuming everyone fully put everything into Brunel, and they grew at 5.5%, they'll be there or thereabouts for the 50 billion by 2030. But yes, but someone is saying there is a direction of travel where big is beautiful. I believe Liz has a question.
Yes, Liz, good morning.
Good morning, Chair. I just wanted to make a point about my concern about investing in private equity. When we've been hearing about the price of placements for children in Somerset and other parts of the country that are funded by private equity and require profits of anything between 25 and 35%. So I can't help putting those two things together and thinking that pension funds investing in private equity at the instruction of the government may simply make matters worse for local authorities. Just wanted to express my concern about that, Chair. Thank you.
I mean, it's a valid point. I would say that's more about whether the care market is broken generally than private. I mean, private equity in that instance are just exploiting a misfunctioning market to make a profit. I know that's a callous way of putting it when it's the particular market in question, but that is the reality. I have absolutely no idea as to whether what we invest in private equity flows back to that. I think it's probably unlikely. I don't think that's the sort of private equity that typically institutional pension funds tend to pick up. But it is a valid point. The government, generally speaking, want us to invest in UK PLC. In my personal opinion, they've got it the wrong way round. What you do is you create an environment that promotes business activity and entrepreneurship. No, you know what I mean. And that will create the startup businesses which then are attractive to institutional investors. And what they're trying to do is get institutional investors to shove money at something without creating more good investment opportunities. And I think they should just concentrate on creating the good investment opportunities, and then the money will naturally be attracted to it, rather than force the money towards something that there isn't anything there to do. Well, just not suitable investments. But yeah, I'm just a humble person who sort of, helps to run a pension fund for a council and a treasury. So what do I know?
Thank you, Chair. I just wanted to make the point that I had joined the two together with nothing that resembles pleasure at all.
I think you've made the point very well, Liz, and there's very few people that would disagree with you, I suspect, other than that bunch of civil servants who want to see that happen. However,
Thank you, Chair.
Thank you, Liz. Any other comments or questions for Anton? The items for consideration at 2 in our agenda pack are to note the progress on the business plan and to approve any amendments. I'm not sure we've made any amendments on that point. And to consider any government consultations and whether the fund should enter a formal response.
There are none open to actually formally open for us to give a response. And as I say, they sort of broadly ignored the response we gave to the last one.
Thank you. I just wanted to make sure we had covered that point. Okay, so with that, then we will move on, and we'll move on to agenda item 9, which is page 69 of your papers.
And this is the finance and membership statistics update, and the membership statistics are on page 70. And as ever, it's a disclosure item. I encourage you to look at the long-term trends, but there's nothing I specifically want to raise around those. I would love to talk about the financial update, but data in MSD is not suitable to produce that in a form that I feel have any confidence in whatsoever, which is increasingly worrying me, because we're getting closer and closer to year end, and I don't have a finance database that actually has all the information I would wish in it to have in it. And I can assure you that I will get back in January and slowly go to war on that. The council is fully aware of it as an issue. the council is aware of the risk, because not only is it a problem for our accounts, but if the pension fund audit gets held up, by definition, every single employer within the fund's audit gets held up, because the auditors of those funds will not place sufficient reliance on the actuary and auditors' work of the fund's accounts that they can sign off those accounts. So it's endemic in the system. It needs to be sorted, and I shall be shoving all weight I have around in January to shift that forward as quickly as possible. I am aware of what the primary issues are, and I have been assured that things are in train to fix them. We just haven't seen it yet.
Do you want a message from this committee to Jason and to yourself about the potential risks involved in not having the right format, if that's the right phrase, for your?
As long as I have your support as I go to war, then that is sufficient.
Okay, well, I'll open it up to the committee, but I don't think anybody's going to say no to this. I suspect this is something that we should be encouraging Anton to do. If we've got a system that's not functioning properly, we need to make sure it works.
I believe,
deadlines, you know?
in fairness to the system, I think the system works. It's just that the data has yet to be put in it properly.
Okay, but that's
So
a slightly different angle.
It's slightly different,
Yeah.
but it's difficult to be sure that the system works when you've got no data to analyze, to check, to use the system to work it, as it were. But my underlying concern is not that the system doesn't work. The pension fund has been set up in a way that is broadly similar to the council. But our needs of the system are massively simpler. So for instance, the pension fund has 40 suppliers set up on the system, rather than, I have no idea, but the pension fund has something like, it's probably about 60 expenditure codes on the system. The council has, I don't know, is it 600? Is it 6,000? It's probably 6,000. So what we input to it and what we try to get out of it is very, very simple compared to what the council. But at the moment, I don't have, the data isn't in there. There is a problem with getting the data into the system. And once that's resolved, hopefully the data will flow in, and then we can have a look at what's in there and check that it works. But I'm in a position of, I'm stuck, and other than make lots of noise and make it louder and louder. But as I say, it's not been the right time to do it in the week before Christmas. But in January, I shall be diverting significant attention to making sure something happens ASAP.
I think upon your return in the first week of January, that's probably at the top of your to-do list.
It is.
And you will be unequivocally supported by the committee. So that report was to note. I would propose that we, David. Of course.
Yeah.
Okay. No, but we'll start with you, David.
Sorry, it's a very technical. I've not come across the term before. The 4.1 table. I'm not sure what an undecided is.
It is what it is, actually. So this is a member that has recently left employment with an employer within the fund and has a choice at that point as to whether they, depending on their age, whether they wish to just leave their benefits, transfer them to their new employer's scheme, whatever that might be, or if they're old enough, take pension. And they have as yet not informed. So they are undecided.
Technically, aren't they deferred until they decide?
Yes. So 10 years ago, I did just lump them in with the deferreds. But at some point, someone decided that it was a good idea for disclosure and transparency to separate them out. So we separate them out. And you'll see on the graph that it's the number of decideds is broadly flat. That is not the same 1,900 people or 2,000 people that have been undecided for 3 years. That is a constant churn. Whereas the number of the pensioners, actually the vast majority of them are the same people, with a few retiring and a few dying. And the actives, you get a few new people join, you have a few people leave for whatever reason. But the undecideds, there's a very high churn. And as I say, it seems to sit at 2,000, give or take a few, forever and a day.
Sorry, can I just clarify? So the undecided figure is not included in the deferreds, it is a separate figure. Okay. It is. Yeah. Yeah. Yeah, that's fine. Thank you.
Okay, Mike Hewitson. Mike, good morning, even, and welcome.
Hello, Chair. Sorry, I can't be there with you in person, but I'm sure you're doing a good job this morning. Anton, it's just a question about the MS Dynamics issue and that in particular holding up audits in the future. Obviously, as Chair of Audit, I want to try and assist you in resolving this problem as quickly as possible. Please, could you let me know if there's any specific support you'd like from an audit perspective to try and help to move this on, because it's concerning to hear.
Thank you, but I don't. It is just about being more vociferous, because I've asked for this to be fixed. I was told it would be fixed. I was given a timescale. I was given a timescale that led me to believe that by this meeting, or by the point at which I produced the papers 10 days ago, there would be sufficient data in the system. And I know who to speak to, and they are aware that I've, and so thank you, but I don't, it is just, at the end of the day, we're in a situation where we're in that typical teething phase with a new system, and bluntly, it's a resource issue. I think everyone knows all the list of things, both the pension fund and Somerset Council, that need to be fixed or improved. It's just sort of prioritizing and ticking things off. Actually, my understanding is that in theory, the pension fund, to get us from sort of 0 to at least 40 or 50 isn't a particularly big fix, should be a relatively small piece of work. Then if the last 50 to 60 or 70 that we want to get to may be more internal and more for me to work with and my team to work with, but we need this fix. We need it's a problem with data integration on data that comes out of Peninsula and should get loaded up into the system, and the module that needs to be built to bridge ours from the Peninsula Pensions Finance system into MSD hasn't been built. Quite in a way.
Is that something within Somerset Council's gift, or is that an external provider?
I don't know the answer to that, because I would speak to Ben Bryant and have a go at him as the person who leads on finance on the system. Whether it's actually physically built by an SC employee or by one of the EY or other consultants helping with the build up of MSD, I don't know. And actually, to be massively blunt with you, I don't care, as long as it gets done.
That's fine. It is on our radar at audit, because it's a concern, because obviously the functioning of that system underpins the whole assurance framework for the council's finances. Yeah. So I wasn't aware that you were being held up by it. So that information hasn't been fed back to me until now, but now it is. Can you keep me updated as to progress with it?
But as I say, whereas Somerset Council probably has a list of teething problems as long as the proverbial arm. For the pension fund, it's just get the data in the system, please. And okay, then we might have to look at the data in the system and redo it and re-reconcile it and things like that. But please just get the data in the system. I mean, one of the ironies actually is my understanding is that Devon are changing their finance system. Is it from April this year? I think it might be April next year, actually. Planning to do it from April 25, I think. And I think that they might be going to MSD as well. But and if they are, I'm sure they'll be learning massively from us.
Yes. I'm sure we'll be more than happy to help them.
But for those long enough in the tooth that unfortunately I am, it wasn't any different when SAP came in. I'd like, yeah, this is what happens when you change finance systems. There are always massive amounts of teething problems.
David.
I just wanted to give a bit of background for everybody. I'm sure people understand, but we had to bring in MSD because you've got 5 councils to coming together with different systems. You needed a single system, and it's better to have a new system that worked for everyone. But I think you're right; it's about resource to input and make it work. So,
done, and why it was done on the time scale it was done, because in fairness to those that have been doing the work, I think the time scale they were given was, shall we call it ambitious at best. And Devon effectively are doing the same project and giving themselves a year longer to do it. But we were, as they say, we were where we were, and we probably made the right decisions for the circumstances we were in. But it's, and this is the result.
Okay, I'm not seeing any other hands up, so that report was to be noted. So it's an information report. So we'll move on to agenda item 10, which is page 71 in your document pack. Anton?
Yes, the risk register. Firstly, just an apology for reasons that we're not quite sure. The appendix was not in the original pack and was sent out as an additional item yesterday. So hopefully you've picked that up and can see it. As you all know, that we had a session, an offline session with committee and board together on the risk register. We had I think it was a 2-hour meeting. It was probably a bit longer on the risk register specifically, went through it in considerable detail. And so there has been a number of changes and amendments to the risk register as a result of that work. I hope I've remembered and reflected that discussion correctly in what I've put in the risk register. If anyone feels I've done it poorly, please let me know. Because it's one of those classics that you think your notes are strong enough and everything as you're doing it, and then you come to it and you go, what? I'm sure there was something else that was spoken about. So there are a couple of new risks and there are tweaks to a number of risks. And I'm going to say that I can't remember what all of the changes were because some of them were quite minor. For those that weren't involved in that discussion, the new risks are around data protection was one, and accounts was the other. So breach of data security or related data protection GDPR issue is PF Admin 7 and has been added as a new risk. It's not to say it wasn't being managed, it's just that it's explicitly on the risk register. And I'm trying to find where I added in the accounting one. Yes, PF Gov 3, failure to produce accurate and timely accounts leading to qualification of the accounts by external audit. So those are the two new risks. Happy to take any questions, comments around the risk register.
So I'm going to refer to Appendix 10, Appendix A, and it's the second page. Sorry, I've got it down as PFINV2, which is about the triennial valuation. So it stays as an amber with a combined score of 10. And yet we saw a few minutes ago that actually the funding position had worsened, was now dropped from 95 to 91.7%. So that's the first question of why has that remained as an amber when the funding's got worse? And the second one is, I thought the pensions regulator wasn't happy having over 10 years restoration period, and yet it's here as a 16 year. So is that going to have to drop to a 10 year and therefore would be a greater risk?
So taking those in the order they came, firstly, the actuary does a full reassessment at the formal triennial valuation. The information I provide on the graph is a sort of not a full update. So it's inherently, it's just saying this is what markets are doing, this is what your assets have done, but all other things we're just relying on the private. So unless that was hideously changed, hideously altered, I wouldn't reflect that in the risk score. And you'll notice on the risk register, it does, review again at next valuation, explicitly stated in the risk register. So the idea is that we review that risk at valuation time, not in between. But I appreciate, in the grand scheme of things, I don't think going from 95 to 91 would merit a change of risk score anyway. But I certainly don't think it's a significant enough change to reflect in the risk register mid-valuation. Now, if it went to use an extreme example, 70%, then I think we'd probably put something in the risk register around that. And as I say, if we're in the 90s, then I think that a likelihood of 2 is reasonable. And again, to put in context, because ultimately the risks around the valuation is that we will run out of money at a point in the future to pay pensions. The fund in its current size is, broadly speaking, big enough to pay pensions for the next 27 years without any returns, although that assumes no inflation as well on the other side. But so it's not a short-term impact, it's not a short-term risk. I remain comfortable with the scoring. I am not entirely sure about the TPR's rules. My feeling and understanding is that they don't apply to the LGPS on that time scale. But I've never been made aware of that being an issue by anyone, including the actuary, who I would expect to be aware more so than me of the TPR's regulations if they applied. So we did start at 25 years, 9 years plus 1.5, because 9 years is to 2022. So it is my full expectation that at the next valuation, the 16 will become 13. Government, as part of the GAD section 13 review, so that's where the government actuary department review all of the actuarial valuations after they've happened, and sort of switch them all to a consistent calculation and assumptions basis, because none of them are, and go, well, who looks like they might be underfunded or overfunded, or through that mechanism, they've made it very clear to us that they expect us to continue to make progress in reducing deficit recovery periods. Again, if we got ourselves into a situation where we had a 25% collapse in market values between now and the next valuation, and so at the next valuation we went in pretty much expecting 75%, I think there would have to be a realistic discussion all round as to whether funding periods needed to go back up.
Any other queries or questions? Yeah.
Just a quick one, Mr. Chairman. On the long-term staff sickness, do we have any indication on the numbers?
I would have to refer to Shirley for Peninsula Pensions. I would have thought, broadly speaking, within Peninsula Pensions, which is a 65 individuals, or is that 65 FTE? I can never remember. It's something in that ballpark. That long-term sickness would probably be more manageable. If you're losing, I appreciate it comes down to grade and expertise and things like that. But if you're losing one person out of 60 to long-term sick, it shouldn't. Yeah, you should be able to cover that to some extent. Within the investments team, where there's only 4 of us, it's 0. I think the longest absence I've had within the team, I did have someone on long-term sick for 6 months actually, but we backfilled that. And that was one instance in 20 years, and beyond that, 2 weeks is probably the longest, or 2 to 3 weeks. So it's very much a risk for the investments team because there's very few of us and the expertise is very concentrated, but the instance is very low historically. But I mean, that's true of any council section that is relatively small, where the expertise is concentrated. So you'd have the same risk in the insurance team, for instance. And as I say, I'm sure there's a large number of teams across the council that would qualify for that. In the short term, there is always the possibility of chucking money at it and getting consultants in. It's not something I personally would ever be keen on, but if push comes to shove, there is always that option.
Okay, I'm not seeing any other hands up or people requesting to speak, so I think we have considered that report. So we will move on. Item 11, which is knowledge and skills.
The only updates I wish to give on this is that you should have all had an email from Barnett Waddingham with links to a nice portal where you can demonstrate your expertise. And I would encourage you to engage with that.
I will.
And then for next year, the focus of training will be around that, building up towards that decision around the investment strategy. And so we'll start the year 90% in training mode and 10% in discussion mode, and we'll end the year sort of 90% in discussion and decision mode and 10% in training mode.
Okay, well, I too would encourage everybody to pick up on that email and complete the forms.
I suppose
I'm always happy to trade my own ignorance. I don't know something, I don't know something.
2 things on knowledge and skills I should point out. Firstly, it is something that attendance at committee and attendance at knowledge and skills and your engagement with that portal does get put in the annual report and accounts. So it is a transparent mechanism. The other thing is that one of the things that was completely uncontroversial in the government's consultation was them saying that they would wish to put committee training and skills and knowledge on a more formal regulatory footprint. That was almost unanimously agreed by all respondents to the consultation. And so whilst I don't believe from what I've seen the government's requirements will go much beyond what we already have. So we already have a written training policy for committee, and we already transparently disclose engagement by the committee in that training policy and uptake, etc. There may be some additional requirements, but it's going to become more formalised as we move through the next year. And again, I suppose it's the thing that might get dropped because it's not a government priority per se, but it's something that's definitely not going away. So even if we don't get regs and guidance next year, we'll get it. It will come. But as I say, from what I've seen currently, I think we're already at a broad level already doing it. There just may be some tweaks around the detail again.
There's a note in the chat asking for that email to be recirculated. So if we can make sure that happens, please.
I'll have to, because that came direct from Barnet Waddingham.
Okay.
So I suppose I should, as it will come from someone that most of you will have not had any contact with,
yeah.
Please can you check your junk folders?
Yes.
But
that's a good idea. And can I encourage everybody to complete it as soon as is practicable, please? Go on.
No, sir. Right. Okay, only just to say that I have completed them, and they are quite straightforward, but for everybody not to be too disappointed on the first attempt.
I actually think it's a very good idea to increase our knowledge, even if it's sometimes just the terminology used. I think we will all benefit from it. And that in turn means that the members of the pension fund will benefit from a better knowledge of the people on the committee. So I would strongly encourage everybody to complete it as soon as is practicable.
Nothing says Christmas.
Well, we're probably going to have to wait until Christmas Eve to get the funding settlement, which is what we did last year. So
again, as someone who's been around for a while,
yeah, you're not surprised by that either.
No, I'm struggling to remember the time that the local government settlement came out earlier than Christmas Eve.
Yes, quite. Yes, indeed. Okay.
Yeah. I believe it came from Mark Macaulay at
Macaulay
at
Barnet Waddingham.
But on the basis that I didn't actually see,
we'll get that checked and get it sent out again. Okay. So Paul,
yeah. I'm sorry.
Could I just ask that if we haven't responded, there's a chase, because I'm not convinced I've seen that in my inbox.
Names and nothing's come into my inbox.
No,
I'm not sure the spelling of Macaulay is correct. I could be wrong. I don't want to. If we can do that, excellent. Okay, right. Item 12 on our agenda is any other businesses of urgency. I've not been made aware of them, apart from I'd like to wish you all a Merry Christmas and a Happy New Year, and I look forward to seeing you all in the new year. Those that I don't see between now and the end of the festivities. Thank you all for your assistance and contribution this year. I look forward to us having a full and frank discussion, as we always do, and we go into the new year. So thank you one and all, and a Merry Christmas and a Happy New Year to you all, one and all.
I think Michael Dunk would like to say something.
Well, I'm not sure if it's relevant to raise this, Chair. I just wanted to, if there's a very, very quick update on where we are with the discussions on the communication policy, communication and engagement. Excuse me.
As stated in the business plan update, we're waiting for the admin strategy to be approved, because that has certain elements of comms that we would then wish to replicate in our comms policy. So it's, and all other things being equal, I would expect the comms policy to come to committee probably in the spring, probably at the April meeting. I mean, no, not March. Sorry, I'm getting June.
In the summer. In the summer.
Early summer. All other things.
Thank you. That's just me sorted.
Okay, with no other hands up or requests, I will thank you all and close the meeting. A couple minutes to 12. Thank you very much, one and all.